Hello everyone, good evening. Welcome to Momentum Lab. As all of you know, that Smart Money channel is now Momentum Lab. Thank you for joining us in our journey. And without further ado, let me get into the video of today. So today is the part 2 of the part 1 that I had already done on building a momentum portfolio. So how do you do it yourself? How do you build your own momentum portfolio? So in part 2, I will be covering 3 things. Two things, in fact, two main things, which is when do I enter the market to create my own portfolio, and when should I exit? And when should I exit also has 2 parts. When should I exit individual stocks, which will be covered under the subtopic of rebalancing your portfolio, and when do you exit the entire market completely? So when do you close your portfolio, close shop, and say this is not the right time that I am in the market, right? So let us cover these 2 topics. So momentum investing does not work in all market conditions. I think it's very important for us to know when we are building our own portfolio as well, that it works only in few market conditions. So what exactly are these market conditions, and how do I identify which market condition we are in, so that if I can take the call of going ahead and building my portfolio or not? So let me in this part try to explain to you how to identify the perfect market conditions for building your momentum portfolio, and also in general to understand what are these different kinds of market conditions. So just to simply put, there are 3 kinds of market conditions. There is upward trend, where all the market is going up. It's, I think, very simple to understand. The market is going up, everything is healthy. Of course, there will be adjustments, but in general, the market is going upwards. The second is a sideways trend. This is a market condition wherein there are ups, there are downs, and overall, if you look at the journey of the market itself will not have changed much. So it goes up and falls that much down, goes up again and falls that much down. So overall, if you take a long period of time, the market would not have changed much. Its value would not have changed much. And the third and last trend is the downward trend. So I think it's just the opposite of upward trend. So a downward trend is where a market is clearly showing signs of losing its value. The market reduces to lower prices each and every day, and it keeps forming lower lows over the previous days. So these are the 3 market conditions. And there is one thing that I would like to tell here, that most of the times we mistake and we think that people lose money during a downward trend, right? That sounds very obvious, because the market is going down, and if you invest, you will lose money. But funnily enough, people lose money, traders lose money when the market is in a sideways trend. Why, you may ask? That's because in a sideways trend, a market gives you a lot of signals. It says, listen, I'm going up, here is a signal. And the moment you invest all of your money, you probably will hit your stop loss in a day or 2, sometimes even the same day. And this happens several times. And when you overtrade like this, you lose a lot of your money. When it is a downward trend, I'm sure most of us who know how to identify the trend and know if it's a downward trend, we will not enter at all. So sideways market is where a lot of traders and traders lose money. So it is important for us to understand these trends and also identify perfect entry points, correct entry points when we are deploying funds into the market or building our momentum portfolio. Let me also show all of this with a chart. So if you see this chart, I'm here actually using TradingView. You can use any other software that you're comfortable with. I'm also using the Nifty 200 index chart to show you all of the trends and how market trends look like. For example, if you see the time period between 2018 to around early of 2020, you see that the market is in a sideways trend, right? So there are up points, there are down points. The market is really finicky. It's not making a particular judgment towards a direction. It's not going up, it's not going down. So this can be considered as a sideways market. In fact, let's just say you get a signal to enter over here. Of course, there's a small up move, but immediately you'll also see a huge down move. So in a sideways market, it's definitely best to keep yourself out of it. And from this is the COVID crash, and you're seeing this is a downward trend. This is a clear downward trend you're seeing at the COVID crash. Now, from here onwards, you're seeing some kind of upwards movement, but from 10th of November 2020, you're particularly seeing that the market is going up again. So these are the 3 different trends. There is an upward trend over here. There is a huge downward trend over here. There's also a sideways trend over here. Now, let us see how the returns differ for Nifty 200 index, and I will compare it with Nifty 200 Momentum 30 index. As we discussed in part 1, Nifty 200 Momentum Index is an index that is tracked by the NSE, which is rebalanced every 6 months, and they release out this index. So if we see these two indices, we'll understand how momentum is performing in which market conditions and how the index itself is performing in which market conditions. So this is also to sort of reiterate the point that momentum works best in an upward trend, and it's best also not to be in momentum, hold a momentum portfolio during the other trends. Nifty 200 index is being marked by the purple line, and Nifty 200 momentum 30 is being marked by the orange line. The Nifty 200 momentum index tracking by NSE is being done from October 2020 onwards, 2020 onwards. So we have data only from that time. In fact, during this period, in the last 4 years, we also have good, the chart shows all the three trends, but making it easy for us to understand. When you look at the sideways trend, which again starts from October 2021 to June 2023 sorts, you see that, at some places, in fact, the purple line is doing better. It would have been better if you stayed in the index instead of looking at a momentum portfolio yourself. So the sideward market trend is not the time when we build a momentum portfolio. And if you look at this upward trend from, let's just say, October 2023 onwards, you'll see that the momentum index, the momentum 30 index, has made around 185% returns, has given 185% returns, and the index itself has given 125%, making it an alpha of 60%, over 60%. So it is a clear indication that the momentum index itself works, during upward trends. If you also want to see how, our indexes performed during a downward trend, we see that in a short period of time from April 1st, 2022 to around September 2022, October 2022, you see that the index has performed better, in fact. So it's always better to sort of hold an index rather than build your own portfolio. So with these charts, it is established that it is best, upward trend is the best time for us to build our momentum portfolios. After establishing this, there are three important principles, the simple principles that one needs to keep in mind before they enter into the market. And these principles, in fact, together give us an entry signal, what we call as an entry signal. Why are these principles important is because, there are several times that, market starts going up, right? There are indications that the charts are looking up if we are just looking at visual cues. And when that happens, we just simply cannot assume that the market has resumed its uptrend, because if you look at it, there are huge corrections before the uptrend actually takes off. So when is the point? When can I say that, an uptrend is actually happening? When do I know that this is an uptrend where entry can be taken? So just to establish that, we have three simple principles. Let me take you through them. So these are the three conditions which we have to, or principles that we have to look at when we are taking an entry into the market. So the first and foremost is that market is in an uptrend, right? So how do we establish this uptrend? There are two ways to establish it. One is just visually looking at it. But I have already discussed previously by showing the chart that just because it is visually looking up does not mean that the trend will continue, right? So we also need clear indications about an uptrend. That we will look at by using EMAs, or the exponential moving averages. We will be comparing the closing price with 21-day, 50-day, and 200-day exponential moving averages. I will also show you how you can mark all of this on the chart. So once we discuss the points, I will be taking you there, so not to worry. And the second important point is that the index should be making an all-time high. Sometimes it actually looks very contradictory, right? Because once it's making an all-time high, when the index is making an all-time high, most of us would like to pocket in the profits for a little bit, or pocket in our own efforts, and then see how it goes, because we're all scared of the fact that, maybe the market will fall down. I'm not saying the market may not go down, but I'm saying that there is a different way to look at it, and I will take you through that in detail using a chart. So one, we need to know that the market is an uptrend using EMAs, and second one is that market should be making all-time highs. Market should be making all-time highs. And the third one is that we also need something called the market breadth to improve. What is market breadth, right? Simply put, market breadth is the health of the stocks of the index that we are looking at. So let's just say, of course, in Nifty 200 index, we have 200 stocks. Let's just say that 50 stocks in the Nifty 200 are performing really well, and those are pulling the index higher, and it looks like the market is going up. But if 150 of the remaining stocks are doing really bad, they're making lower lows each and every day, each single day, then essentially we cannot say that the market breadth is good. The market breadth is simply not good. However, in vice versa conditions where 150 stocks are doing really good and 50 stocks are not doing very well, we say that the market breadth is good. Why is it so important for me to know if the market breadth is well or not? The market is going up, it's in an uptrend. Isn't that enough? No, it's not simply enough, because we are not investing in all of the 200 stocks of an index, right? We will be selecting the top 15 or top 30 or based on whatever your strategy is. So for us, we choose the top 15 momentum stocks, and you probably have a different number for yourself. Now, when we are picking 15 out of 200 number, right, we want the probability of us picking a winner or us picking a profitable stock to be higher, right? So that will happen when the breadth is good, which means if out of 200 stocks, 180 stocks are going up and I happen to pick 15, then the probability that most of these 15 fall in that 180 is very, very high. But if 180 stocks are performing really badly and I only have 20 stocks that are performing well, the probability of me picking 15 out of those 20 really well performing stocks is very low. So just to keep our chances right, just to fine tune our methodology and strategy even more, we'd like to see that the market breadth is wide. We'd like to see that there are many, many good stocks out of the index that we are considering for our momentum portfolio to be good and healthy. So let me take you through the chart again once more to show you how you can mark all of these three indicators and find a right entry point for yourself. Here again, we are with Nifty 200 index chart. What I have added here is I have added 21-day, 50-day, 100-day and 200-day EMAs, exponential moving averages. But we'll only be considering the 21-day, 50-day and 200-day EMAs. 21-day moving average represented by the blue line, 50-day moving average represented by the green line, and 200-day moving average represented by the red line. Now, as I've said that when we look at an uptrend in a market, we also need three more things to tally, right? So that we know exactly that the market is in an uptrend. Now, what we need to know is that the closing price of the index is above the 21-day moving average, which is above the 50-day moving average, which is above the 200-day moving average. Only then can we say that the market is an uptrend. Now, if you look at different points, of course, this small uptrend over here, we again see that the price is greater than the 21-day, which is greater than the 50-day, which is greater than the 200-day, right? So we do have at these up move, we do have these EMAs lining up very well with our closing price. Now on a downward trend, however small it is, whatever it is, we see that all of these moving averages do not align up. Sometimes the 21-day moving average is way below, the 200-day as well. So the EMAs correspond, the positions of the EMAs corresponding to the closing price is a very, very good indication to find out what trend of the market we are in. Now, even if you look at during the sideways trend, we see that there is overlap between upward, downward, etc. Even the EMAs and the closing prices show us the same thing. Unlike in a clear uptrend where continuously the movement is towards this in the same direction, a 45-degree slope. Now, coming to the next point of why we need to look at all-time highs for the market, let's just take the small slope, upward slope here, right? The market is, and we don't have information pertaining to anything after 12th of December 2022. So we don't know if the market is falling up, down, going side, what is happening. Only till here, when we see that, the market is an upward trend, EMAs align, 21-day moving average is less than the price, and 50 days lower, 200 days lower. So all of this indicate an upward trend. But if I take an entry over here, immediately I will be thrown out because you see that the market has taken a downward turn from that point. So, and that happens several times. See, there is a point over here, even over here, even if it's not at the previous high, it's still in an upward trend, but could not establish itself. So we do have several points where the market is reaching highs. But what we need to know is that the market is at all-time high, which means that it has breached this resistance point. So over here, October 2021 levels are the highest point ever known till here. So though it comes here to this, though in December 2022 it has come to a similar point, we need to know that this resistance point has been breached. Otherwise, we won't be able to say that it is at the high. It is at an all-time high, right? So we come to June 2023. Not only do we know that it has come to the previous high, but if you wait for a month, a few more weeks for signals, it will also show you that the market has breached this resistance successfully after about 2 years. And it has made all-time highs. Now, this confirmation is what we want so that we do not see these many fluctuations. The third point is market breadth. Now, how do I define market breadth? Like, do I have to go to all of the individual 200 stocks and see if they're doing well or how they're doing? How do I make this comparison? there is one user on TradingView called Equity Craze, and they have made it easy for us to understand. They have an indicator. You go to indicators and look for it, you will find it. The indicator is NSE India market breadth, net new highs. So essentially what this indicator does is it shows you how the breadth is. So if you look at this, there's a clear indication of red and green. So if the market breadth is good, if sufficient number of stocks are in moving upwards, then we get a green indication. And if if sufficient number of stocks are moving downwards, we have a red indication. And all the whites are gray areas yet to be defined. Now, we also need to compare the all-time highs and upward trend with a market breadth. Now, again, if you look at this small sideways slope, there are several points where you will find uptrend. You will also find the green market breadth. That means a healthy market breadth. But you will not find that index has reached an all-time high. Now, if you look at this particular point where the resistance has been broken, you clearly see that there is an uptrend, established uptrend. We established it both by visual cues and also by EMAs. All-time high has been reached, resistance has been breached, and the market breadth is very healthy. So clearly, using all the three of these, you can time your entry points. So let me also show you let me also take you through several openings for an entry. So several entry points that have come across throughout from, let's just say, October 2021 to now. So here is in front of you a chart again. I'm using the same chart, Nifty 200 index, and I'm going to mark all of the entry points by marking with a visual cue of when the market is in an uptrend, right? So points 1, 2, 3, 4, and entry, let's call it 5. They are all indicative of uptrends in a market just with visual cues. Now, the first of our condition has been met, that market has given us a cue that it is an uptrend. Now, the second condition of the principle that has to meet is that the market has to be at an all-time high, right? So if you look at point 1, it's not even reaching its previous high. So naturally, this is not qualified irrespective of what the market breadth says, right? So we don't have this qualification where it's at all-time high. It's not at all-time high. Same goes for point 2 and same goes for point 3. Now, what we are left with is point 4 and an entry point for the 5. So in fact, let me change it a little bit more and say it's over here. So considering these two as the entry points, these two are actually valid entry points. You see that the market is in an uptrend. You remember the EMAs are properly lined up with the pricing. It's at an all-time high. In fact, if you see that there's a little point where, the candle is also breaching that all-time high resistance and the market breadth is in green. So this is also a valid entry point. However, if you see that after a few days itself, you will see that the market is correcting and it's falling down, and this has been a false entry for us. So without the lack of information about what has happened after point 4 over here, 4 is a valid entry. However, if you look at it, in a few days itself, there is correction and we can see that the market is falling down and the trend was not established. If we do take an entry over here, considering all of the parameters, it was a false entry, right? Nevertheless, we cannot at all points be right. We can't avoid all of the false entries. Sometimes because we don't, hindsight is 20/20, as they say. We don't have all of the information, and when we don't, and if all our criteria are met, sometimes we probably will take an entry at this 4 point also. We would have, and once the market starts correcting, we would have exited, and that would have been a false entry. However, you'd see that we avoided 3 other entries because of the principles that we have put in place. Therefore, all of these principles, sometimes we will encounter false breakouts, and we will also have a false entry point, and we might also take it and soon come out. But with the strategy, what has happened for us is we have reduced the number of times we are entering into these false entries or false breakouts. But now when we come to the 5th or the entry point, this satisfies all of our conditions, and it has properly, in fact, breached the resistance. It has taken a small correction to also come back higher with gap ups. So this particular point would have been a perfect entry point to make your portfolio. Now that is the first part about when to enter the stocks. So to summarize, you have to enter when the market is in an uptrend. Do not hold your portfolio when the market is in a sideways trend or a downward trend. Now in an upward trend, we also saw 3 important points where EMAs are necessary along with visual cues to identify what the uptrend is. The second thing is an all-time high, and the third thing is market breadth. Now, let us move on to the next segment of this video about when to rebalance or when to exit stocks, individual stocks, and followed by when to exit the entire portfolio. When is the right time to sell your portfolio and make money? Now that we have covered when to enter, let us cover when to exit. So like I said before, when to exit has two components. The first component is when do I exit one particular stock, and the second component is when do I completely exit from my portfolio and come out of the market. Now I'll be dealing with the first component of when do I exit one stock. Entering into a momentum portfolio or entering into the market is pretty simple or straightforward considering the principles that we have laid down. But exiting a stock is extremely difficult. Exiting is challenging because one has to be sure that the momentum for that particular stock is over. The momentum is over and there is no more momentum. That is when we exit. But we also learned that stocks don't move linearly, right? Stocks move in an upward, downward fashion, correcting, etc. So in that situation, when a stock is in momentum, there are three ways it can go. It can go upward further, it can take a pause, and it can go downward. And even when it takes a pause or a resting phase, it can go two ways. From the pause, it can go up, or from the pause, it can go down. So it is very important for us to time in a momentum market when I want to exit a particular stock. So there are two criteria that I follow for exiting a particular stock. Let me show you those two criteria. The two criteria of when to exit a stock is the first one being if the price of the stock falls about 20% from its 52-week high or the last year high. When a stock price falls down by 20%, then we exit the stock on the next trading day. This 20% fall in price has to be established during the close of the day. So on the next day, when this happens, we will sell the stock. Or the second thing is during rebalancing, we sell a stock if it falls below the worst rank. Now, what is rebalancing, what is the worst rank, etc. will be dealt with. I will explain to you clearly what exactly do I mean by rebalancing. But however, if you have been investing and if you have been doing any kind of momentum investing or building a portfolio, you would understand or at least heard the term rebalancing. So I will discuss what rebalancing is in detail in the following content. And we will also look at what a worst rank is, right? Now, going back to what I was saying, we will, like I said, a stock will either go up, take a pause, and from there go up or go down, right? And we want to sell the stock only once it is going down and has lost its momentum. Because when it's in pause, we again don't know if it's going to go up. It probably is resting for a little while before the next momentum journey starts. So we want to be extremely sure when we want to exit a particular stock. Therefore, how will we know if a stock is resting, if it's an upward momentum, or if it's going down? In the first video, in part one, where we have discussed what stocks to choose and how to rank, etc., we have understood that ranking is one very important way to find out the placement of a particular stock. So with the help of final rankings or the cumulative rankings that we have calculated for including the 6 months, 3 month, and 1 month performance, is how we will understand where the stock lies and what action are we going to take about it. So how do I find out if the stock is in momentum, it's in pause, or it's going down, right? So right in front of your screens are two sheets. These two sheets are 15 days apart. One on the right over here is of 30th April, and this one is of 15th May. So they are 2 weeks apart, and these are the final ranking. You might be familiar with these sheets if you've seen our part one of DIY momentum investing, building your portfolio. If you have not, I'll be linking in the description that video, and you can go and watch it. Now over here, as you know, we have been selecting the top 15 stocks, and the ranks of each of the stock will be changing every second, right? Because of the way they move, the performance, etc. And that will influence the 1 month performance, 3 month performance, 6 months, and also therefore the cumulative rank or the final rank. So stocks keep moving up and down in the ranks. Now, if I say that the top 15 are the best ranks for me, and anything beyond top 15 is a worst rank, like 16 is a worst rank, then you will see that Indigo, which I have held before, for example, I have held Indigo before because in the previous week, Indigo was in the first 15 ranks. Then because it has come to 17 in the week of 30th April, I will have to exit it. But similarly, that goes for Siemens, Zomato, and OIL and BSE as well, right? So I cannot just consider 15, just top 15 ranks. Now, there is also a possibility that I say, all top 100 stocks is where I draw a line, because if you see Bajaj Auto was held before, I marked it in red because we had the rank has fallen very drastically. So if you say that I'm going to keep 100 stocks and see if my stock is still ranked amongst 100, that will be the worst rank for you, right? So what is a good threshold? There's a fine line between drawing a worst rank, and one must also take a lot of care while drawing the worst rank. So if you draw a worst rank at 15 ranks, let's say I'm selecting 15 stocks and I say that anything that is outside of the 15th rank, so if a stock falls into 16th rank, I will sell it off. Two things will happen. One, you will never know if the stock is in pause and it's going to regain momentum, or the second point is that you overtrade. You keep selling very, very often, and every time you measure for this index, you will have to say no, anything beyond 15 I'm going to sell off. So one, you don't give a stock enough chance to run, or two, you don't even know if it's in pause and it wants to run, etc. So just to avoid this, putting 15 stocks as the worst rank, or the 15th number as the worst rank, is too risky. Now I can, like I said, I can also go ahead and say I will put 30, or I will put 40, or I will put 50. Let's just say I will put 100 because it is the half of Nifty 200 index universe. Now when I do that, what will happen is you will see that some of the stocks are marked here in red and they're losing their ranks drastically. And for them to, maybe reach 100, they can come back to 60 and then again go to 99 and again come to 17 and then go to 100. So essentially what I mean is there'll be a long time before, you figure out that the stock has lost all of its momentum and has not come back at all. And it was in fact, even in downtrend, or from the pause, it has gone to downtrend before you've left it. So it's going to be too late, and 100 number is going to be too linear. So just to avoid all of this and to draw a fine line, what has worked for us over the years is to take double the number of stocks that we invest. So because we invest in 15 stocks, 30 is our worst rank. So any stock which is below the rank of 30 will be considered as worst rank. Right? So now we are clear about worst ranks. Let me also just take an example. Over here, on 30th April 2024, Indus Tower was ranked 1. Right? You'll see that. But if you look at 15 days later, if you look at the sheet 15 days later, you'll see that Indus Tower is now ranked 12. So it has reduced in rank. But however, we'll probably wait and watch if it's taking a pause, or if it's going to run again, etc. So I will wait till Indus Tower hits any rank below 30. Once it goes below 30, I'm going to say, no, this is over for me. It's hit its worst rank. So now I'm going to exit the stock. That is about the worst rank. Now, rebalancing. What is rebalancing? Rebalancing is simply assessing if your portfolio is going according to the risks that you want to take. You would have defined, a certain risk for your portfolio. Like in the first part again, we have discussed that if so-and-so principles are met, if so-and-so conditions are met, I am going to keep my portfolio, of which this ranking system was one as well. So rebalancing is simply to identify what is happening, the changes that are happening in the market, and checking and taking actions. So selling some stocks, bringing in some new stocks, etc. So rebalancing is essentially creating a balance in your portfolio, or bringing your portfolio to those conditions after assessing the risk, etc., and bringing it to that position which is acceptable to you, which you have defined in the first place. Okay, so that is simply rebalancing. Now, how often do you rebalance? Because the ranking of this changes in minutes, right? Every second the ranking changes, like I was saying. Because as the price changes, as buying and selling happens, market being very dynamic, the ranking of all of this changes every minute. Now, am I going to do it every day? Now, if I'm going to rebalance every day, which is monitor how my portfolio is going, where the stocks are ranked, how they're ranked, and what action I should take, then it essentially almost becomes like trading, right? It is very time consuming, and you also do many transactions. You sort of kind of overtrade. You lose a lot of money. Even if you make profits, you lose a lot of money in transaction costs, right? But if you say, okay, let me not lose any money in transaction costs, let me also give it some time to run, and you say, I will rebalance once in 4 months or 3 months, once in a quarter, let me rebalance. If you do that, that is too lenient a time frame. What I mean is, you may have stocks which have risen, taken a pause, fallen down, or taken a pause, risen, and then fallen down, and you probably will give off all of your profit to the market as well. So if you only concentrate on your transaction cost, you might actually, in fact, even lose out on the profit that you initially made. So 3 months is too long. Every day is too short. So what is the right time frame when you have to conduct this rebalancing exercise. The rebalancing exercise essentially is checking your final ranks based on the methodology that I have spoken about in part 1, and then taking call to action, right? So that is rebalancing. So what is the perfect time frame for you to take rebalancing? Now, there are several studies around this as well, and there are studies which say 1 week is fine, 1 month is fine. Again, all of this depends on your universe, it depends on your risk appetite, etc. So what has worked for us is also a 15-day rebalancing. We rebalance once in 15 days. So every 15 days, what we do is we take out the ranks of all of the stocks, all of the Nifty 200 index, and then rank them according to their cumulative ranks of 6 months, 3 months, and 1 month, and check where they are ranking. So because our worst rank is 30, any stock that falls below 30 is sold and is replaced with the next better stock. Right here, you're seeing that these are the top ranks. And over here, the ranking has changed. So now we have removed from this list, let's say, ABB, Bajaj Auto, so on and so forth. After 2 weeks, we again find that ABB is in a momentum list, Prestige comes in, CG Power comes in. So we are going to start from the next best ranks of the stocks that we don't already hold. That is going to be a rebalance exercise. Again, I would like to remind all of you that whenever, for example, ABB is ranked 2 over here, you don't directly pick ABB, but you're going to go back to your sheet and see if the stock has, if the stock's updates are above 50%. That is also very, very key indicator. Once all of the factors that we have considered are fulfilled, we are going to go back, make a new list and rebalance it, so and so. So when do we exit a stock? In 2 conditions. The first one, where the price of the stock has fallen below 20% from its 52-week high. That is one criteria. The second criteria being the worst rank of the stock has fallen below 30. For us, it is 30. If the rank falls below your worst rank during the rebalancing time frame, which is 15 days for us, which could be anything for you, if these 2 conditions are met, only then do we exit a stock. Now that we have covered when to exit a stock, let us also see when should I completely exit a portfolio. When should I say this is enough, let me go out, right? I'll cover that in the next section. Welcome to this section where I will be dealing with when to completely exit from the market itself. When do I completely remove my portfolio from the market? So last section we've covered when do I sell individual stocks, or when do I rebalance my portfolio. But now we'll be covering about what is the time? When should I completely exit? When do I call it quits? Like when do I say that this is not working for me at all? The portfolio is not working. I'm going to come out of the market. So for that, we need to go back and look at one important thing, which is extremely important for anyone investing in equities. It is risk appetite. So risk appetite is nothing but how much you're willing to lose in the market. Given that equities is a very risky market in comparison to other sort of investments, which are real estate, let's say gold, etc. So compared to other markets, equities are really, really risky. You'll all agree. So when you're entering into equities market, one has to sort of understand, one sort of has to come with a pre-understanding of how much they're willing to risk in the market, how much are they willing to lose in the market. In fact, there's also another related thing which you need to come pre-understood, which is how much of my actual investable capital am I willing to put in the market, and how much of that am I willing to lose, right? So these 2 things are extremely important before you go into any sorts of equity investments. In fact, the strategy that I'm going to discuss right now does not only hold good for a momentum portfolio, but it holds good for any kind of equity exposure that you have. So understanding what your risk appetite is extremely crucial before getting into the market, so that our strategy of when to exit is defined entirely around the risk appetite of one person. Before going into this section, I again want to remind all of you that this is not a financial advice. This is exactly what me or my team will be doing or have been doing in the past to sort of manage our portfolios. So getting into it, let me show you 2 important principles that we follow. So these are the 2 things which I have already discussed, that what is the allocation of your total investment are you willing to give to equities? And the second point will be, what is the maximum pain that you can endure? Now, let me also put it in a Google sheet and show you what I mean by this so that it can be easily understood. All right. Now, you have a capital of 1 crore rupees and you say that, let me allocate 10%. I'll allocate 10 lakhs to equities market, understanding the risks and rewards, etc. And I'm also willing to take a loss of 2 lakhs. Now, that is around 20%. I'm willing to take a loss of 20%. So how much of an overall portfolio loss are you going to take? You're going to take an overall portfolio loss of 2%, right? So in a crore of capital, you're willing to risk 2% of your money to the market. Now, if I increase my allocation, let's just say in equities, I want to put 50% of it. I want to put 50 lakhs. Then you're going to be losing 10% of your entire capital, right? So your capital decreases by 10%. which is 10 lakhs, and it becomes 90 lakhs from a crore. So that might be scary for a few people, but that might not be scary for a few people too. So it depends entirely on your risk appetite. And you say, okay, I'm going to put 50% of my capital in equities, but still I want only 2% of my entire investable capital as risk. Then what do you do? The other thing that you can navigate with is the drawdown. When you change the numbers of drawdown, and you say, I can take only 4% of loss, 4% of drawdown from my equity portfolio, then your overall loss again from your entire portfolio remains at 2%. So essentially what I mean to say over here is it is up to you. It is up to the investor to decide what percentage of their entire investable capital they are willing to put in the equity markets, and what percentage of this are they willing to lose, right? So one has to come into the market even before building their portfolio with this kind of understanding that this is the kind of risk I am willing to take. Now, how am I going to understand? Like, there is trial and error sometimes is the only way, but is there another way where I can understand how much losses that market gives in general? Like, if you know what kind of loss that market has given in general, you probably can come at, a percentage of drawdown that you are willing to lose in the market itself. There is a scientific analysis that we can do and find out what has happened to Nifty in the last Nifty 200 index, which is our investable universe. So we will look at the last 10 years data and analyze it to see what kind of drawdowns has happened, right? What kind of drawdowns has Nifty 200 index undergone, so that I can also understand what is common, what is not common, what is the average rate, and therefore look back and adjust at what is my equity allocation out of my total portfolio. Now let me take you through that. And to understand that, what I have done is I have converted the Nifty 200 index values from 2014 into NAV. Let me show you with a graph. Now, what you're seeing is the Nifty 200 index converted into NAV, which means that if one person has invested 100 rupees somewhere around 2014, around 2024, which is 10 years later, that value would have become 400 rupees, almost 400 rupees, which is 4 times. It is a pretty good rate. But what you will see along the way is that it has not been a linear move. It has not been a straight move. So I just put 100 rupees and I sit down for 10 years hoping for it to become 400 rupees. It's kind of not the same. There have been several drawdowns, several times when the market has fallen, market has experienced crashes. Like there was demonetization, there was ILFS crisis, then there was COVID, and then there was also Russia-Ukraine war, etc. So there are several times where we see that the market has shown huge drawdowns. There are also there are also smaller drawdowns that the market has shown. So analyzing this data, what we can say is that between 0 to 5% loss, there have been several instances. It's pretty common for the market to fall to around 5%. There are many, many instances. But from 5 to 10%, it is pretty common, but still slightly lesser than 0 to 5%. And beyond 10%, market falling below 10%, the instances are very less common. And if you go beyond 15% or 20%, it becomes almost rare, like maybe once or twice, etc. If you look at the absolute fall, below 35%, the market has never fallen in the last 10 years. So we are seeing a pattern emerge over here, right? Just to put it in numbers, if you see, the market has fallen or has undergone a drawdown of 0 to 5% about 216 times, which is around 52% of the time. So it's pretty common for the market to correct 5%. So if you put a drawdown of 5%, perhaps you'll keep exiting very soon. You'll probably be overtraded, right? But if you look at 5 to 10%, it's still half of it is around 125, which is 30%, around half of it. And then 10 to 15%, it's around 12%, right? So overall, if you categorize between 0 to 15%, there are 95% occurrences fall in this category, which means it's very, very common. 95% of the times, the market has corrected from somewhere between 0 to 15%. So if you come and look beyond 15%, if you say 16 from 16% onwards, the instances have become less and less and less and less and less. It's very, very rare that the market corrects so much, unless in black swan events. If we go back and look at it, so the market corrects very, very few times in such deep troughs. Right. So though it's a very common, it's very common to have market corrections between 0 to 15% and not very common for the market to fall beyond 25%. I can't just simply say let me just take 25% risk, or let me just take 35% risk so that I'm not out of market at all. Let me explain why. If you look at this correction, which touched around minus 20%, it took almost a year and a half for it to come back to the normal, to the level at which you probably would have invested. So it's often not possible for all of us to just put our money in the market and say, let me wait for, even if the correction is at 20%, I will wait for a year and a half or two or whatever it is that it takes for the market to bounce back. So oftentimes we can't do this, and which means we need a sweet spot somewhere between all of this. Now, if you just look at the statistics, beyond 15%, that is from 16% to 20% onwards, I think if one can hold on, which is again our calculation and what we sort of follow, it is not a financial advice. Therefore, I would be very, very, very in taking this as a financial advice. Please use this as educational content and discuss with your financial advisor about what should your percentage be and how should you conduct your portfolio. So coming back, if I am okay taking anything little more than 15%, then I would have avoided 95% of the drawdowns in the market, which is pretty safe. Now, considering all of this, I should also know how to calculate my exit, right? I know, let's just say I know 10% is the drawdown, max drawdown that I can have, and this much XYZ is the amount that I'm investing in equities. But how do I know when is the correct time for me to exit? How do I calculate that? Let me also show you this in a Google sheet, which will make it easy for you to further understand how to calculate when your exit point is. Again, if you see, this is an example, something that I have picked up from our own portfolio, my own portfolio, which has been running from the 1st of April, which is being built publicly along with my colleagues. This is a snippet of that I have taken from 1st to 16th of April. In my mind, I have 15% as the max drawdown. So what I will do is, this is my portfolio's NAV, and that NAV I will multiply by 85% to get the exact value at which I have to exit the market. Now, as the portfolio value increases, as the portfolio value improves, the SL also, the stop loss or the SL also improves. The exit point also improves. Now, let's just say at some point in the future, my portfolio NAV hits 120, value 120. So at that point, my exit value becomes 102, which is essentially greater than the amount that I brought in, right? I brought in 100 rupees and my exit point is at 102. I am seeing some profits over here. There are also two different ways that one can take from this point onwards, which is that you have gotten a profit. So why can't I increase my risk appetite? Let me increase my risk appetite and say I will take 20% loss, right? I take a 20% loss, which means that I am increasing my chances of being in the market because I know I am in a little bit of profit. I want to wait much more. So I increase my risk appetite at that point and improve my chances of staying in the market, therefore seeing much more higher returns. But there's also another side to it. Let's say you're a conservative investor. I'm a conservative investor for the moment. And I say, I have got some profit and the market looks like, it has reached an all-time high, or, it has reached a comfortable point for me where I want to exit. Now, in that case, I can also reduce my risk appetite from 15% to 10% only. And I'll say, listen, I'm going to take home 8 rupees. I'm going to, if the portfolio NAV falls to 108, I'm going to exit, I'm going to call it quits and take home 8 rupees. So you can do either of it. You can either stay in the market by increasing your risk appetite and say, increasing your chances of staying in the market, or you can become conservative and say, now that I've seen profits, I've gotten more than what I've invested, the strategy has worked. Let me reduce my risk appetite and take home something, pocket something, take home something, right? So again, all of this, including the amount that you want to invest in, the amount you want to risk, when you want to exit, how you want to exit, depends entirely on the person's risk appetite. So your risk appetite. So one has to be sure before getting into the market, even when you're tracking your portfolios, to see when is the right time for you to exit. So to sum up, completely exiting your portfolio from the market is a personal call and has to be based on two important principles, which is how much equity you're bringing out of your total portfolio and how much of that equity you're willing to lose. Now, in all of this, there is an important point that's coming up, right? Tracking your portfolio. It's extremely important to calculate your NAVs, calculate the trailing stop losses, understand your portfolio in units which are comparable to the index, etc. So how do you track this portfolio? A lot of people have also requested us to make a detailed video about tracking the portfolio. Based on your request, we are now coming up with a course. It's a short course on tracking your portfolio, and it will be available to all of you. I will put the link in description. Please go ahead and check out the course if you're interested in understanding the A to Z of tracking your portfolio. Thank you once again for joining Momentum Lab. We'll see you soon.